Hey everybody, we're live. It is Cowboy Metals live stream for February 7th, 2023. I'm your host, 𝘎𝑗𝘾𝙊𝙀 with �GoldSilverPros.com, and we are going to do a real quick sound check, make sure everything's working. While I do that, reminder, everybody, there is a poll up, and the poll is, do you believe the current system of taxes across all levels is fair, just, and or effective? And you can answer that for either one of those questions. Right now, about 88% saying no, 12% saying yes, but it needs some changes. And as is a straight yes, no answers to that one. Thank you, everybody, for joining the program. We're running this a little bit early today because eventually what I want to do is get it down to about 2 or 3 p.m. Central Time to do our lives and get it away from the evening time because it just helps us on the channel not run too late. But also, we do have an active viewership in the middle of the day. So we want everybody to be able to have a chance to come and access a live. So we're going to move it a little bit earlier and see how that goes. So we're going to move it an hour earlier today, a little bit more than that in the future, and see how that goes. Thank you, everybody, for joining the program. Appreciate everybody being here. We're going to jump right into the presentation. And we're talking about taxes today. The reason we're talking about taxes is one of the things you'll notice as the nation state ages, the politicos, in order to pay for all of the graft and the programs and social and all that and the wars, you know, and to deal with the bankrupting of the nation, start turning to taxes. And we've seen a lot of tax proposals. So I want to talk about how you can use gold and silver, but also beyond gold and silver, you may want to move out of your state when you see what we've got coming up. Now, disclaimer of this video, I'm not your tax advisor. I'm not here to give tax advice. I'm simply talking about what has been in the press in a public format. So please do not take anything I say as financial advice. Contact your own legal and or financial representatives before making any decisions. Do not trade on anything I tell you. That is the disclaimer. That being said, let's jump right into it. And again, we're just talking about what's going on. The first thing I actually wanted to start off with is just a story here at 𝘎𝑃𝑗, and it talks about Goldman, one of the big banks, saying households have been burning through a majority of cash and they have no more savings. So this article is basically saying, you know, much like Germán Vázquez, most of us have no money. And so taxes going forward are going to be very important for us. And there's two types of taxes. There's taxes on income, which is the flow. And then there's taxes on stock and flow, right? Investments fall under stock and flow. And some investments are long-term holds. And there are taxes being proposed to tax those before we even get to the flow part where we actually liquidate the asset. For example, many of you have heard recently the administration wants to propose a 20% tax aimed at billionaires and unrealized gains. Originally, they were talking about taxing all unrealized gains, and now they're going after the quote unquote bad guys who have money to make it more palatable for everybody else. Because if you said if we're gonna tax everybody 20% on their unrealized gains, including people that don't have money in the bank, but have some investments, you basically would force them to sell their investments possibly at a loss to cover your gains. So what they're doing now, I think, is they've modified that approach. The administration realizes that's not going to be very politically popular, and it's going to probably anger their base. And so now they've changed it to a 20% tax aimed at billionaires. Here's a problem with that, and we're going to read an article in which taxfoundation.org, this is their opinion, not mine. Again, consult your own legal advisor. But we're going to talk about what they say could be the issue with not only that, but another type of tax. So this is the 20% tax aimed at taxing you on something that you have held as a long-term asset that doesn't have a gain yet. If you don't have cash flow from other things, you have to sell this asset to pay the taxes. Of course, it's very destructive to a lot of financial plans, why a lot of people don't like it. The billionaires 100% are going to put pressure on the administration to say, screw you, because their entire portfolio strategy is probably built around taxes, the current tax structure. And if you change that, they're probably not going to be too happy. This is going to be worse. If you guys live in one of these states I'm about to call out, you really may want to think about moving, because not only is at the federal level, are they trying to take your unrealized gains and basically tax your unrealized unrealized wealth from your stock when you may not have any flow or income to pay for it. Here, the states want to take aim at your investment as well, and their wealth taxes. So another type of wealth tax. So why is this all occurring? Before we get into it, it's occurring because the nation's broke. We're running current account deficits every single month. We no longer pay attention to the debt ceiling. We just print more money. We have more sovereign debt than any time in history. The corporates have more corporate debt. People have more people debt. And so there's no money in our nation right now. We are effectively bankrupt A lot of the wealth is in derivative investments that's going to go away anyway when the Ponzi collapses. I refer to our videos on Exeter's pyramid. So what they got to do now is they got to tax to keep the government from going insolvent. The government doesn't want to break its promises because it knows that we're going to turn them over and get new guys in there. So this is part of them keeping the status quo. And also every nation state does this when they get broke. And we're going to talk about where this has failed and many other nations. They get into it in this article. So it says here, wealth taxes are back in a big way. In a coordinated effort, lawmakers in 7 states that collectively house about 60% of the nation's wealth, which includes California, Connecticut, Hawaii, Illinois, Maryland, New York, and Washington, are introducing wealth tax legislation on Thursday. Now I'm going to show you where this is very unpopular, but let's get into what they're actually trying to do first so we can see why it's unpopular. I'm going to do a real quick sound check again, just make sure everything is going well. Thank you guys for joining the program. Sound is good. Back we go to the share. All right, so as we're looking at this, it says the campaign is part of a broader national focus. I'm reading from the article on new taxes on investment, entrepreneurship, and wealth. For instance, a pending proposal in New York would yield nearly 30% tax on wealthy New York City residents' capital gains income, about 50% higher than the 20% federal tax on long-term capital gains. So the state wants 30 out of half. They want to drive it to half. 20% goes federal, 30 to state. Yeah, that's not going to be popular. Elsewhere, lower estate tax thresholds would impose the tax on upper middle class and not just the very wealthy, including the small businesses and farms policymakers have long worked to protect from estate taxes to avoid forcing them to break up to pay the tax. So in other words, because it's stock and flow. So they're taxing stock now, not flow. Typical taxes go on flow, your income, that's your income tax, your sales tax. Stock taxes include things you own like real estate. Well, now they're wanting to do a real estate like stock tax on everything. Okay. And typically in real estate, you make that work because you work on monthly payments, you escrow your payments, and then you pay your taxes and insurance at the end of the year. The escrow company, mortgage company does it. And so you pay for it out of flow. You pay for it out of your income that pays the tax on the stock, the real estate. You're not getting money from that real estate. You haven't sold it. You haven't realized any gains. So you're paying from your income, your flow to pay for a stock. But a stock asset like real estate, which moves until you sell, doesn't produce income, especially if it's your primary home. Well, stock and flow taxes only work when there's enough flow to pay for that stock tax, to pay for that tax on that asset. The problem is when they're talking about wealth taxes in the middle class, most middle class don't have a lot of money. And so you're asking them to pay out of their flow, out of their income, a tax on a stock asset, which you haven't sold yet. That's going to be an issue. It's going to bankrupt a lot of the middle class. And a lot of the rich aren't going to like it either. It's going to screw up all their tax and wealth management strategies, their generational strategies. I mean, I could see a lot of people saying, screw you, but this is what the governments want to do. It says, and continue to read from the article, and the wealth taxes themselves would vary across the 7 states, partly due to differing state constitutional constraints. Not that constitutions will always stand in the way of legislative proposals of wealth taxes transparently in conflict with Washington state's constitution, but that's not stymied prior proposals and isn't standing in the way of a new effort unveiled on Thursday. California proposals have tended to include exit strategies designed to continue to tax those who respond by leaving the state, then implicate a host of federal constitutional provisions. The reality has provoked little consternation among supporters. And most prior proposals would tax worldwide net worth for state residents, with all the constitutional questions that raises. Now, the United States already tries to do that. If you leave the U.S., they try to tax your worldwide income. If you're a citizen, you have to renounce citizenship. There's a trap there. If you renounce citizenship, they immediately do a wealth tax on you, on everything that you own. Contact your tax advisor for that. That's my understanding. I'm not a tax advisor, but a lot of those exist at federal level, now trying to bring it on state level. So not only would you be locked in prison state America from a tax perspective, you may be locked in prison state New York or California. That's why I'm saying you may want to consider moving now. If you've ever thought about moving anyway, and it's something you thought about, and this tax bill is going to hit you in a big way, it may make sense to accelerate that move and get out of the state before that applies to you. Because if you're out of the state and you're not a resident before this applies, there's such thing called as no ex post facto, no law after the fact. So if you're out of that state when they pass a law, it doesn't apply to you, or shouldn't legally or lawfully, I should say. Let's make that distinction. There's a difference between law and legality. We'll talk about that in another episode. By the way, if you guys have been following Unfiltered and you're members of the program, supporting the program in that way, today's episode on Unfiltered, I talked about the difference between legal and law, not only for purposes of understanding taxes, but just in general. And I'm not a lawyer, but we're talking about things in the public domain, like such as from Cornell and stuff like that, about how the law works. That's important to understand. It's a important part of our mind map that we understand our finances, not just gold and silver. Anyway, back to the Tax Foundation article. The constant, it says, across all 7 states or wherever such taxes are proposed. Wealth taxes are economically destructive. This is according to the Tax Foundation, not me. Their base is almost impossible to measure accurately, and they would create perverse incentives and promote costly avoidance strategies. Very few taxpayers would remit wealth taxes, but may more pay the price. So in other words, the wealth tax, how they're trying to get it across is saying, well, we're not taking your asset, we're just taking value out of it from a tax perspective. So they're not bankrupting you as much as they're just basically forcing you to dispose of that asset or get to your disposition strategy before you may want to. And that may cause a loss. It may cause a book loss in terms of you sell it for less than you bought it, or it may cause a loss of your investment strategy in terms of you don't get as much because you're not able to hold that through whatever your investment strategy is, if it's a piece of real estate or a bond or whatever the case may be, precious metals. The article goes on to say, proponents sometimes argue that wealth taxes are small and the rich can afford them, but because the rates are on net worth, not on income, it's a stock, not a flow tax. They cut deeply into investment returns to the detriment of the broader economy. Average taxpayers may not care if the ultra wealthy have lower net worths, but they certainly will care if innovation slows and investments decline. That's the other part of it. Will this kill innovation? If you have a tax strategy around your company or business and your tax strategy changes, which forces you to change your company or business, you may be slowing or killing innovation or driving people out of that market to begin with. That's something that we do need to talk about when we're making changes to nationwide or even statewide tax policy. And that's something we should be doing, is talking about it. It says here, we're not accustomed to thinking about taxes in terms of stocks, accumulated wealth, rather than flows, income streams. To most people, it's not intuitive how a wealth tax rate compares to something we better understand, like income taxes. Imagine a $50 million investment held for 10 years, earning 10% nominal annual rate of return, 3% annual inflation environment. Let's say real estate, for example. This is a real estate example. Without a wealth tax, that investment would yield $46.5 million in investment returns over 10 years. That's a 93% increase, not too bad. With a 1% wealth tax, however, it would yield just $37.3 million. The wealth tax would wipe out nearly 20% of the gains. A 1% wealth tax knocks out 1/5 of the gains. Small tax, big impact. That's what wealth taxes do. Small tax, big impact. If the gains were realized at the end of 10 years, so the investment went to fruition, a 1% wealth tax would have reduced gains by as much as 20%. So that's basically doubling the federal capital gains, essentially. A 1% wealth tax from the state would essentially double the capital gains you pay at the federal level. That's a lot. So it doesn't look like a lot on surface, but because it's on stock asset against all of that asset, it's a lot, and it may force you to sell that asset to pay that tax at the end of the year if it's on unrealized gains, wealth gains. So it depends on how they implement. Do they do an unrealized model or a realized model when you sell? It makes a difference. So all these calculations, blah, 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 I'm not going to read it, but it says here, the result, a 1% wealth tax erodes about 20% of the investment income. That ain't good, and a lot of people aren't going to like it. And if prior efforts are any indication, some of these proposals will have a base of fairly liquid, publicly traded investments for which there's a known market, but others, potentially including California's, would tax all assets of the wealthy, many of which lack a known market value. This could include tangible assets like artwork, as well as non-financial and tangible like trademarks or goodwill, which can be nearly impossible to value. Worst of all, it can include ownership stakes in closely held corporations and partnerships, which often defy valuation and could cause them to have to split up to realize that tax. You may be splitting up businesses, something to think about. I wanted to get down here to where they said other countries have tried this and basically said, yeah, no, thanks, including a lot of other socialist countries basically said this don't work. It says here, according to Tax Foundation, at either end of the spectrum, of course, there is a prospect of exit. Those subject to a wealth tax could decamp to another state, a move that is far easier at the state and the national level. In fact, the economic consequences, both from out-migration and lower economic activity, are so significant that even at the national level, most countries have abandoned any wealth taxes, talking about moving away from the state. Well, guess what? I've got data for you on moving away from the state and where that's already occurring due to existing tax provisions in states that are considered a bit more socialist and willing to pass those. So let me go to a spreadsheet in which I downloaded some data from the census, and I'm going to show you exactly what that looks like. Let me make sure you guys are seeing that on the screen. This is from the census, and I'm going to show you that as we get to the spreadsheet. I sorted the data, so at the top I've lost my headings, but they're down here. So here's a disclaimer saying it's from the census. You guys can see that. This is from census.gov as of 2022, release date as of December 2022. And I added 2 columns here. The first column is the population increase or decrease, because it's got population for 2020, 2021, 2022. And then I put an increase or decrease, and then as a percentage of the overall population. And you'll notice a lot of these states that want to pass a state wealth tax, I've highlighted in like light orange here. So New York, Illinois, California, Hawaii, Maryland, Minnesota, Connecticut, and Washington, all basically liberal states essentially, are all the ones that want to pass that wealth tax. And the connection between levers and wealth taxes, or levers and high taxes overall, is already shown. New York has lost the most, not the most people, almost the most, is like the second most, but they lost the most as a percentage of their population. So they started at 20 million, now they have 19. They've lost almost 3% of their population in the last 2 years. Part of that could be due to pandemic policy, but a lot of it's due to taxes. The state that lost, or the area that lost the most is the Northeast. But I find it funny that California and New York, when you look at these 2 states, California and New York, line 1 and line 6, lost almost as many people due to their existing tax and socialist policies, as did the entire Northeast. The entire Northeast lost 568,000. That includes Mississippi, Massachusetts, Michigan, Ohio, so on and so forth. Or I'm sorry, no, the Northeast. These are all out of whack. But the whole Northeast section of the country lost about as many as did just these 2 states in California and in New York. And as a percentage of population, New York was the highest. Illinois was up there, negative 1.83%. California, negative 1.3%. Hawaii, negative 1.05%. Maryland only lost 0.20%. These 3, Minnesota, Connecticut, Washington, smaller states, though being a bit more liberal and thinking about these laws, have actually added just a wee bit. Now, a state such as mine that's very strongly in favor of business added 3%. It was in the top 6% of adders. The number 1 in terms of overall numbers, 884,000, state of Texas, but 1, 2, 3, 4, 5, 6th place in terms of percentage. And then places like Idaho, Montana, Utah, Florida, South Carolina, a little bit more fiscally conservative, are adding people. So people have already are flowing already before these taxes have been passed. Just the existing tax structure, the existing political structure, the existing cultural structure has caused people to move out of these states already to these other states. And what's going to happen, ladies and gentlemen, when they pass these taxes? Well, what did this article say about when other countries had passed these? Let's go back to that article. What happens? People moved out. Let's reread this. Both from an out migration and lower economic activity, meaning people leave and the state generates less revenue because people are less active economically because there's less incentive to be active. They were so significant that at the national level, most countries had abandoned any. So I do think if at the federal or the state level, a lot of these wealth taxes and these types of taxes are enacted because people don't have a lot of money, they're going to move. And you're going to see that movement out of those states increase quite a bit. And that's not any sort of surprise to me whatsoever. And I think that's what you're going to see. Now, what does it mean for gold and silver? Well, I'm going to show you a little calculation here, and it's not for financial advice, but I want you to see how, one, if you move out of state and go to gold and silver, those 2 things may end up giving you the best overall outcome for you saving as much as you can. So we're going back to that spreadsheet. And if you look, here's the census data and the population. I did a little scenario analysis. Now, I got to read this disclaimer down here in brown. The scenario and information for research purposes only. We're not tax or financial advisors. You must consult with your own of each type of those advisors before making financial decisions. This is a simple scenario analysis to be used only for educational purposes based upon commonly held knowledge on gold tax rates as provided by the IRS on their website, and with regard specifically and only to the stated tax rates on gold held over 1 year as a collectible. All numbers calculations are purely hypothetical or not to be construed as likelihood or fact. Now that I got that out of the way, let's talk about what I got up here. So I'm looking at gold in the current system here, this side, and then I got a divider, and here's gold at a wealth reset. This is all hypothetical, not to be relied on as strategy, but it gives you a scenario analysis of what can happen. So let's say you purchase gold at 1,600. I'm just going to say we all did. just for purpose of illustration. So you're going to have some gain whether you sell today or in the future. You bought at 1600, good on you. You bought it a couple of years ago. Gold value now, let's say somewhere around 1870 in that range. Just for grin and giggles, we're going to use that number. The profit then would be this number minus this number is $270. If you paid that 28% collectible, that's currently what you pay if you hold any sort of gold or silver bullion or jewelry over 1 year, is taxed as a collectible at 28%. Now, you won't pay your ordinary income tax rate. You'll pay a capital gains rate, but that capital gains rate's higher than capital gains rates on other things because gold, silver, bullion, jewelry is classified as collectible. Look that up on the IRS website, consult with your attorney, but that's what I got from my research. So assuming 28%, you paid $75.60, your gain was basically $18.70 you realized it at, minus your tax of $75.60 minus your purchase price, you came out with 12%. So if you bought gold at 1600, normal tax rules apply, you're at 12.15%. Now, if you were to pay that capital gains rate on existing wealth before you even sold it, and let's say it was 20%, you're basically negative on your bullion because you would pay 20% now, and then by the time you sold it, you would have taken a loss. Well, not a loss. You would have extinguished a lot of your gains up front because you're only paying 20% on the gain. So it would have been 20% of about $195. So you still would have made money, but your percentage goes down. Well, let's talk about holding gold. Let's say you move to a state which doesn't have a wealth tax. So you avoid that whole long-term capital gains, unrealized capital gains, and that the feds aren't able to pass that. So the feds can't pass their version of it. You stay out of one of those 7 states, like you live in Texas or someplace where you don't have that wealth tax. And so you escape all that. And let's say the financial reset comes and everybody says gold's now valued at 5,000. It's not 1870, but let's say the reset happens and everybody says we got to revalue gold to keep the dollar from collapsing. Let's put gold at 5,000. We'll recapitalize a new currency on top of that. And then the old currency will be devalued. You would actually have 153% gain. You would have a profit of $3,400, remember, because you bought it at 1600. Now, a lot of this is paper profit because they revalued the new currency, but you still came away, you came away paying higher rates, still 28%, 952, but your gain, all of that together, I5 minus J5, that's this amount minus the purchase price, minus what you paid, you still come out way ahead. So if you're able to keep away from wealth taxes and you buy gold, and this is the big caveat, no guarantee, and that gold gets revalued at some point in the financial system reset, no guarantee, but hypothetically, if that were to happen, you've kept most of your gains because you don't have that wealth tax. Now, if you had that wealth tax, it would decimate those gains. You would still have gains, but think about it this way. We think the government's going to revalue gold to reset the currency system and the new digital currency. And so with any sort of wealth tax, the government would then claw back a lot of that gain by virtue of the new system and a revaluation of gold. If you're a gold holder, do you want them to do that? Or a silver holder, do you want them to do that? The answer is probably no. So just think about if that Biden administration 20% wealth tax passes, estate tax, and or the state one passes, and depending on what they tax you at, you could lose a lot of the value that you're buying your gold for now. They could take that back in the form of taxes. I mean, if you had planned on using those gold and silver gains and you pay your 28% normal collectibles, and then, yeah, you're still paying 20%, 8% of your gain, but your gain is on so much more money, you could use that money to go pay off an old contract and the old money, maybe come out ahead. Or at least you would have some fiat gains there to offset the losses of all the stuff going around us with the economy, inflation, crashes, whatever. Okay. But if you're in one of those states where you have a wealth tax, well, a lot of that advantage just got stolen from you by the government. And if the feds pass a wealth tax, a lot of that advantage got stolen you by the federal. And so that's how taxes can affect your portfolio strategy. I just want to make you aware of it. I'm not your tax advisor. Consult them, please. But I want to make you aware of the potential for that. If I'm reading this correctly and I'm reading, these articles correctly, them explaining what would happen, that's not good for you guys, especially if you hold gold and silver. Because if you have gold and silver and you're paying higher taxes, a lot of your gain is gone. That's not fun stuff. That's not what any of us wants. Now, if you are interested in gold and silver, we do have an affiliation with One Arc Silver. We do get benefit on the program for this. We do get a small percentage of sales, not a high amount, believe me, but everything that we do get from sales does benefit the program. There are sales that Ian has right now that he came on the program just yesterday to talk about. I'm going to put that back up on the screen. Let me get it ready to do. I'm going to put that back up on the screen. This is exactly as it appears. As of yesterday on the program, Ian came on with ARC Silver, and these are the deals, and only these deals. If you buy a 1,000-ounce bar, you can get that for 79 cents per ounce over spot. If you buy a 1 kilogram silver bar, and these are all silver deals, by the way, no gold, all silver. If you buy a 1 kilogram silver bar, you get that $1.95 per ounce over spot. The following 5 government minted coins only, silver at $3.33 over spot. That includes silver maples, silver Britannias, silver Armenia Noah's Ark, silver Philharmonics, and silver kangaroos. And if you get the American Silver Eagles specifically, and you buy a monster box at minimum, Ian will sell those at $7.50. ARC Silver will sell those at $7.50 per ounce over spot. All of that is somewhere around 50% of the premiums I've seen at other places, maybe a little bit higher, but you're getting almost a 50% discount, of course, limited quantities. And to get that deal, go to our website, goldsilverpros.com, and simply click on ARC Silver and click the form and fill that out, and Ian will get back to you. We've had really good response the last few weeks. He offered spot gold and silver at one point. That deal is no longer in play, but he's came back with this deal for what I just put up on the screen only. He's done very well. If you want anything outside of those deals, or if you want to make a big order, Ian has access to a lot of the wholesalers. He can get it to you probably cheaper than anyone else. So those deals aren't the only way you can get cheap gold and silver. They're just the best deals he has right now. But if you're interested, email him off of our website, and he could provide you, if you wanted to do a different order or you wanted something that wasn't on sale there, he can help you out with that as well. And he can scale it up to as big orders as you want. The biggest one that we've had come through our network to him was about a month or so ago, and it was $3 million. We've had several $500,000, $600,000, $700,000 sales go through, and we've had small sales of just a couple of coins. Ian works with all levels. All right, let's go back to the poll, ladies and gentlemen. Ending it up, do you believe the current system of taxes across all levels is fair, just, or effective? 94% said no. That's your answer out of 117 votes. 4% said yes, but it needs some changes, and 2% said yes as it stands. That's going to do it for the poll. Thank you, Peter Frohwein, for being our moderator, riding shotgun on Cowboy Metals Live. Once again, to date this, it is February 7th, 2023. We started 4:30 p.m. Central Time live. We're going to move these to either 2 or 3 p.m. live in subsequent weeks, just letting you guys know that ahead of time. We're going to be coming a little bit earlier to free up our nights a little bit. Plus, if you come at night, you'll still be able to participate in the lives. You can watch the replay. You'll still get that content. As a reminder, on Monday nights, we're going to have Ian come and do his metal market update every Monday night. And so we'll give you the deals then as he has them. And he's coming out with a Shopify store. We're coming out with our bar. Stay tuned to that. We will have a bar out pretty soon, which we'll talk about. I don't want to announce it just quite yet and how to get it, because we're working on all the logistics. But once we get it there, you'll be able to go online to an automated ordering, order the bar. It'll be fulfilled through ARC Silver as well. We're getting all of that built out. Thank you, my friend Daniel Vigario, for joining us from the fair burg of London in the UK. Join us from across the pond. We appreciate you. And that's one of the benefits of doing these early, is I get my across the ponders can come join the program. That's another reason why we do it. We want to make it accessible to everybody. That's going to do it for today, guys. Thank you so much for joining the live. Thank you, everybody, for hopping on, riding shotgun with us, and being a part of the program. This has been the wealth tax proposals, crushing tax proposals, why you need gold and silver, but why the jurisdiction you're in matters when you buy gold and silver. That matters too. We wanted to inform you of that. Don't just go buy the gold and silver. If you're going to buy it, know how you're going to be taxed and where, and get the darn heck out of Dodge if you got to do that ahead of time, if that is what you want to do for your tax strategy. This is going to do it, guys. Thank you so much for joining the program. Until next time, it is Rob Kientz with goldsilverpros.com. Stay on the channel. We got more video content down there for you, including a series by me and Mr. Daniel Vigario on the Perth Mint. Always worth a second watch of you guys. And if you guys haven't watched that, watch it. It is a cautionary tale about what to look out for if you're buying gold and silver from somebody storing it, especially overseas. Pay attention to that. Till next time, Rob Kientz, Gold Silver Pros.